One of the problems with having a career for so long as a financial advisor is that a lot of the things that I learned, a lot of the things that I did on a daily basis become second nature to me.
But what I do have are a very particular set of skills. Skills I've acquired over a very long career.
So because of that, there's a lot that I don't realize is not second nature to normal people. That's one of the reasons why I want you guys to make comments, to tell me what you want to know about, to ask questions, because I'll definitely answer all the questions I can. This is Paul Mann, the Realty Man. 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 Oh, the Realty Man. 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 Hey everybody. Welcome to episode 3 of Ask the Realty Man. I'm Paul Mann, the Realty Man. So today we're going to talk a little bit more specific about what exactly a Roth IRA is and what a traditional IRA is, what the difference is between the two. A traditional IRA is the original type of IRA. Right now in the year 2017, you can contribute $5,500 per year into a traditional or a Roth IRA. So it doesn't matter what type of IRA you have, your limit is still $5,500 a year. And that could be all of it in one or the other, or it could also be you split it between the two. Either way, the maximum that you can contribute is $5,500. If you're over the age of 50, you can actually contribute an additional $1,000 per year. So you can put $6,500 into your IRA. One of the benefits of a traditional IRA is that it's a tax write-off for you for the year that you make a contribution. So what I mean by that is, let's say in the year of 2017, so this year, your income is $43,450. Now remember, we have a progressive tax rate in the United States right now. So what that means is that any amount that you make over $37,950, you're actually paying 25% taxes on that amount. So if we contribute the maximum to a traditional IRA, which is $5,500 for the year, that actually drops your income down to $37,950. When you take money out of this IRA, of a traditional IRA, that's when you pay taxes on that. Now at that time, let's say as long as you're over 59 and a half years old, that's when you can take the money out with no tax penalties, but you will pay income tax on that. So that's why when you have money in a traditional IRA, you need to be careful once you retire how much you take out, because it can bump you up once again to a higher tax bracket. A little bit of extra tax planning now can help you later when you retire. And one of the ways to do that is with a Roth IRA. Same limits, remember you can contribute $5,500 in there, but it's not a tax write-off right now. So even if your income, use that same example, is $43,450, you contribute $5,500, you're still going to pay income tax on that $43,450. So you get no tax breaks or tax benefits today on the Roth IRA, but any growth that you receive on that is tax-free. Now that's not saying everyone needs to put all their money in a Roth IRA. Go back and look at my last video, the law of parity. So if you're taking all of your income from your IRAs once you retire, you can take $37,950 out of your traditional IRA. That keeps you at a 15% tax bracket. And then you can take another, let's say your living expenses for that year are $60,000. You can take the other $22,050 out of your Roth IRA, and that still keeps you, because you don't pay taxes on the withdrawals from the Roth IRA, that still keeps you in a 15% tax bracket.